The UK joined the EEC in 1973.
Britain without Europe would be both weaker and less prosperous.
And this evolved into a single market of 450 million consumers, the world's largest trading bloc and accounting for 42% of UK export. The single market was an important feature of UK economic growth and investment. But 8 years after the 2016 referendum, there is a growing regret that leaving the EU was a mistake, with a majority of Britons expressing a preference for rejoining the single market. Even a relatively conservative estimate predicts Brexit could cause average incomes to be £2,300 less than if we'd stayed in the EU. But how much of the UK's economic problems are actually related to Brexit? And is the time right for thinking of rejoining the single market? Since 2019, the UK economy has actually performed slightly better than Germany, and some may point to that as a sign that leaving the EU was not such a bad thing. But other EU countries, such as Italy and Greece, have seen much faster growth in that period. But comparing UK economic growth rates and wages to other European countries is a very poor method to measure the impact of Brexit. The real test of how Brexit impacts the UK economy is to look at how it performs relative to if it had stayed in. In terms of the economy, Brexit has imposed several costs: higher tariffs, lower investment growth, weaker pound, greater business uncertainty, and higher custom checks, with more set to be implemented in the coming year. On the positive side, the balance sheet is fairly weak. Free trade deals with Japan, 11 Pacific countries, Australia and New Zealand barely move the dial of GDP. For example, a free trade agreement with Australia and New Zealand might lead to 0.1% increase in GDP by 2035. Now, the government can point to strong growth in service sector exports, but this is mitigated by falling level of export of goods, which are more affected by post-Brexit frictions. Now, the most pessimistic analysis of Brexit has come from Cambridge Econometrics. They claim the UK economy has already lost around 140 billion in gross value added, and by 2035 they claim the UK economy may be 10% smaller than if it stayed in the EU, and in terms of investment it could be 35% lower. Now, this research has been criticised for being too pessimistic, overestimating the impact of Brexit. In particular, they claim that Brexit leads to fewer jobs, but actually the impact on labour supply of ending free movement has been less than many forecast, because we've seen a rapid growth in non-EU migration and growth in the labour force that way. So if that model is to be believed and the UK had stayed in the EU, the UK would have had one of the highest per capita growth rates in Europe, which is quite hard to imagine given the UK's political instability and long-term structural problems which predated Brexit. Nevertheless, more cautious models do suggest a significant economic cost. The OBR suggests the UK economy has lost 4% compared to if it stayed in the EU, which is around £80 billion, and that means a loss of around 32 billion in tax revenue. And to put that into context, it's equivalent to a 6% cut in the basic rate of income tax. The National Institute of Economic and Social Research forecasts a slightly larger fall in GDP of 5.7% by 2035. Now, over the course of 15 years, that's a lower growth rate of about 0.3% a year. But if you accumulate all that loss over the many years, it amounts to around £2,300 less per capita by 2035. And this is a loss which will be magnified because of the poor real income growth the UK has experienced in the past decade and is forecast to keep being low for the coming years. Now, it's worth bearing in mind that recent UK economic difficulties have been much more than Brexit. There's several factors at play, such as austerity, poor productivity growth, low investment, and then the shocks of COVID and the Ukraine war. But Brexit has definitely been an additional drag on the economy, in addition to all these other problems the economy has. Now, one issue with rejoining the single market is that ending free movement of labour was a significant aspect of the Brexit campaign, even if not everyone supporting Brexit wanted to leave the single market. But there are two interesting aspects of free movement with Europe. Firstly, in the early 2000s, there was very large wage differentials between the UK and Eastern Europe. For example, in 2001, UK wages were 5 times higher than Polish wages. So it's not surprising there was a large movement of Eastern European workers to the UK. However, since Brexit, that wage differential has narrowed. And on current trends, by 2035, this wage differential could be almost entirely eliminated. Therefore, in the future, there will be less pressure on large-scale migration from Eastern Europe because wages are converging. Now, the second factor is that migration from the EU was particularly beneficial in terms of the government budget because the European Union is close enough for migrants to come to work, but also close enough to go and visit family. Non-EU migration comes from a much greater geographical distance, and so there's a greater desire for migrant workers to bring their family as well. And this is one reason why switching from EU migration to non-EU migration caused bigger than expected migration numbers. And this also helps to explain why EU migrants tended to have a larger net fiscal benefit to the government than non-EU workers. The typical EU migrant was young, actively working, and therefore paying tax but not receiving pensions or so much healthcare. Now, one reason behind the Brexit vote was the sense that public services were failing. Even in 2016, there were long waiting lists. But since that Brexit vote, waiting lists, if anything, have continued to grow and increased pressure on many government departments with real cuts in spending in education, courts and prisons. Now, in the case of NHS waiting lists, COVID was a big factor in causing a sharp spike. But even so, the sustained rise in tax as a share of GDP is a concern because it suggests that the economy is struggling to grow quick enough to pay public services. Now, rejoining the single market does have a disadvantage in that one of the biggest costs of Brexit was the political uncertainty and division it created. Rejoining too early could bring old arguments and divisions to the fore, and that sense of political paralysis could negatively affect investment, which the UK has definitely struggled with in recent years. The UK has one of the lowest rates of investment in the G7, and it struggled to replace investment from the European Investment Bank. And also there's a practical point that after several years of rather painful negotiation, the EU is probably keen to move on, not keen to restart negotiations. There would at least be a wariness of whether the UK was actually made up its mind. Perhaps one lesson of Brexit is that if you're planning large constitutional change, it's desirable to have something of a supermajority, or at the very least a very clear idea what the constitutional change is going to be. Now, one step towards closer ties with Europe without much costs is dynamic alignment. This basically means that the UK accepts European Union rules, and this is something that businesses are actually quite keen on simply for practical purposes. And it's relatively easy to implement, and it will mean that the UK doesn't need to start checking food and drink imports, which it is set to do this year and will lead to higher food prices. But once you go down the route of dynamic alignment and become a rule taker of Europe, it is effectively a step closer towards a single market and rejoining the customs union. For example, if we don't check food imports, it will be hard to negotiate free trade deals with other countries who want specific food standards. Now, perhaps the easiest thing to change is for the UK to rejoin the EU customs union. This avoids the political issue of free movement, but it will have significant reduction in costs for many small and medium-sized firms in particular. It means the UK won't be able to negotiate free trade deals with other countries, but this has proved very challenging anyway. The US is not really interested in finding time despite a so-called special relationship, and free trade with Australia and New Zealand was criticised by farmers as being a sellout, and a free trade deal with Canada has broken down due to Canada's protecting hormone-treated beef, and a free trade deal with India broke down because of dispute over the right to work. So the result is that the UK access to Canadian markets is now worse than before Brexit. Cheese exporters and car manufacturers are particularly frustrated. So rejoining the customs union would help to reduce a lot of the new costs and trade frictions that have sprung up in recent years. Trade openness in the UK has definitely fallen in the past few years, and it used to be a great strength of the UK economy, one of the most open economies in the world. And rejoining the customs union would be particularly desirable by the food sector, which is quite concerned about the costs of checking imports of perishable food. Also, leaving the single market and customs union has required a border between the UK and the European Union, which has been particularly problematic in the case of Northern Ireland. At the moment, we have a kind of, you could say, fudge with a softish border. The Windsor framework removed most, but not all, checks between the two countries, but it always remains a potential for a flashpoint, and closer ties would definitely help to avoid this friction. Now, Brexit has imposed costs on the UK economy, but what else explains the general economic malaise the UK has experienced since 2010? This video goes into more detail about all the problems affecting the UK.